Right now, we are in uncharted waters here. The global debt is growing and growing and growing. We had the Biden administration recently get their $1.9 trillion stimulus rolling. They've talked about as much as a $4 trillion infrastructure. And just yesterday, we saw making its way through the media rounds was another round of a quote unquote relief bill. And so the debt seems to be tacking on. Everyone's wondering, where is this all headed? And so today we have Michael Pento. Michael is actually really expert kind of on this in this subject. He wrote a book about the collapse of the government bond market. So we're going to be discussing this global debt, this monetary system, and more importantly, how we can prepare ourselves and make sense of everything that's happening. And so right there down below, you'll see Michael's website. Make sure you hit the like button on this side or this side to send this video out to more people. Last but not least, just a shout out to our channel sponsor, which is Vizsla Silver. So if you are looking for a mining stock in the silver space, check out Vizsla Silver and give us a comment down below that says Mike rules if you're familiar with Mike's work. And it's good to talk to you.
Good to have you, good to have me on the program and to have you as a new friend. Thanks.
Yeah, absolutely. So, when I look at what's happening, it's hard to make sense of it at all, really. I mean, where the heck does this go? Especially seeing yesterday, the Biden administration said they have another relief bill on the way. And I'm just going, I have a 7-month-old daughter, and I'm just going, where is this going? We've got an incredible amount of people unemployed and all these types of things like that. So why don't you start and give us an idea of how you see what's going on and where this whole thing is headed?
Well, it's not your dad's or your granddad's market any longer. I guess at one time you could have said, well, let me just buy some stocks and I'll buy some bonds depending on my age. And you know what? Wall Street continually goes up. So since 1981, there's been a bull market in bonds. The price is up, yields down. And we put up a chart of the S&P 500. It's been a rocket ship, especially as we get these iterations of Fed money printing. So really, what's the problem? Like, what's really the problem here? Well, and then all of a sudden, every few years, you get a glimpse. The veil is lifted as to what's really happening here. And I'm going to try not to get too arcane, as we talked in the pre-interview. But you have to understand what's really happening, and you have to deal with some numbers. So first of all, you have to deal with the fact that the U.S. national debt is now 135% of GDP. That is the highest percentage that has been outside of World War II in the years 1942 to 1945. And we were fighting a world war, and we won the world war, and we had all of the world's manufacturing and all of the world's gold, and we had the world's reserve currency. But we don't have, that's not what we're doing now. We're not fighting a world war. We're not defeating Nazi Germany any longer. What we're doing is handing people out checks to consume. Here's another, I'm sorry, I hope I don't bore you with a lot of numbers here, but it bothers me, and it should bother you, and I think viscerally it does, because you've had me on the program and you're talking about the subject to your audience. It should bother you that the Federal Reserve printed almost $7 trillion since the year 2008. Monetized, fake money, Al Capone style. And they did so to make sure that interest rates would be almost zero. And they have been less than what interest rates, the Fed funds rate, which is the basis of all of the cost of money, that's how it's derived, has been less than 1% for 10 out of the last 12 years, less than 1%. That's never been done before. And what happens when you take interest rates to that unimaginably low level for that duration of time? Well, you get massive asset bubbles, and you engender a tremendous amount of debt. I mean, what would you do? What do you do when money is free? Well, why you borrow it? And then, like I said, you get once in a while, you get glimpses as the veil is lifted on this artificial edifice that we have become in the United States' new brand of capitalism. And things collapse. It happened in 2000, happened in 2008, happened in 2018, and it happened in 2020. And we're not fixing the problem, Jake. This is not, okay, this is something we're doing temporarily, but look at the healing we're doing. We're vanquishing asset bubble. We're crushing asset bubbles. We're normalizing interest rates. We're paring down debt. We're doing none of that. We're doing the exact wrong thing with greater intensity and with longer duration.
So what are the results of this? Is it just, you said every few years the veil is lifted, right? Is it this keeps going where we have these flash crashes, something breaks, and then they throw more at it, then we go to the next level, and then 2 to 5 or 7 years it happens again, and then it just keeps going until one day people lose faith in a currency, or where does this really go? That's what I'm so interested with regards to the future.
Yeah. So you could be a money manager, you pretty well summed it up very well. So the basis of my investment firm, Pento Portfolio Strategies, the whole progenitor of my inflation, deflation, and economic cycle strategy and model that I've created, is you're going to get periods of time when you have massive deflation and collapsing asset bubbles, which were preceded by incredibly huge asset bubble booms. And again, you saw that in 2000, 2008, you saw it in 2020. You're going to have cyclicality in this, where you see, like we're in now, periods of inflation, periods of growth, albeit very anemic for certain parts of the economy, but really, really strong growth for the highest tiers of the economy. I mean, you think about it, who really fared the best in this current crisis of pandemic? Well, it's the 1% and less, the 0.01%ers who have many houses, who have huge bank accounts, who have huge stock accounts. And who did really poorly? Well, if you were a renter, you're not going to buy a first-time home now, because home prices have gone through the sky because of what the Federal Reserve is doing, making money free. So hedge funds can borrow a lot of money for almost nothing and buy tracts of land and houses. Doesn't help you if you're a renter. If you're a renter, you probably don't have a massive stock portfolio. I don't believe that's the case. And by the way, if you are in the bottom 25% of income earners in this country, you probably were devastated by this pandemic, in that you used to be a waiter or a waitress or a Walmart greeter, and you lost your job. So not only have you not benefited from this asset bubble at all, these asset bubbles at all, but you've probably had a loss of income. And you cannot make that loss up with innocuously, harmlessly, by just having the government send you a check, all of it which is monetized by the Federal Reserve. That is not a viable prescription for a healthy economy. So to answer your question, you're going to continue to get these cycles of depression, followed by cycles of booming inflation and asset bubbles. That's going to continue until, as you said, so beautifully said, you're going to have a collapse. Finally, you will ultimately have a collapse in the fiat currency system, not the dollar per se, the fiat currency system and US treasuries. That's coming. And then eventually you'll have maybe some kind of great reset where finally central banks say, hey, we can no longer do this. This is not working. But this is not going to happen next year or 3 years from now. It's going to happen when we have intractable hyperinflation globally, and there's a revolution not from central bankers. They're not going to reach this epiphany. They're just all about power. Where they say, listen, we are demanding, the people demand that money once again become real. Backed in specie, meaning it's going to have to be backed by either gold or silver, preferably gold, in my opinion. And why do we want to do that? Why would people do that? Well, because of the chaos that was caused by these decades of fiscal profligacy across the developed world. But why link it to gold? I mean, why not just link it to, like, seashells or something, or Bitcoin? Because the mine supply of gold increases commensurately with population growth and productivity growth. And if you have a money and a currency that's commensurate with GDP growth, which is what I just said, population and labor force growth and productivity growth, then you'll never have any asset bubbles. You'll never have any inflation. You're going to have stability in currencies. You'll have stability in inflation, and hopefully even stability in tax rates. All those things will have stability if you have a currency and money that is fettered by gold. And I think when this ultimate crash occurs, after the concurrent hyperinflation happens across the developed world, and people demand that their money be real, then you'll have this ultimate deflationary crash. That'll be a deflationary crash. But then hopefully that puts us on a trajectory of many decades of prosperity globally.
So how far away do you think we are from something like that? Is that 50 years away from the tires finally, being unfixable?
So, it'd be foolish for me to make a prediction like that. I can tell you that it's not anytime soon. I mean, listen, I'm not here I'm not trying to sell a gloom and doom newsletter. I'm not trying to sell gold or precious metals. What I'm trying to do is trying to make my clients money in all cycles, either deflationary cycles, disinflationary cycles, recessionary cycles, depression, boom, inflation, stagflation, all cycles. I try to make money by identifying where we are predicated on my model. That's what I care about.
So where are we right now? Inflation or deflation?
So right now we are in an inflationary cycle. There's no doubt about that. And to boot, you're having some growth, albeit, as I said, anemic for certain people, but very, very robust growth if you're in the upper classes. And why is that? Why do I say that? Well, when is the last time you had an economy, a U.S. economy, borrow $6 trillion? And this $6 trillion was borrowed from March of 2020 to March of 2021. $6 trillion, just in that time frame. We're not done yet, by the way. We have, I believe, we have another $3 trillion. It'll be spread out over 10 years, I believe, but a $3 trillion infrastructure package coming from Mr. Biden, probably be announced later this week. We're recording this on Monday morning, so perhaps around before Good Friday, he'll propose his $3 trillion stimulus package. So when you borrowed $6 trillion, so it was $4 trillion in 2020, the last $900 billion approved in December last month for Trump's administration, and then you had a $1.9 trillion on top of that just approved a few weeks ago. When you have that much fiscal stimulus, and the reason why it's stimulus is because the government didn't borrow it from the private sector. They didn't steal the money from the private sector, which is what they, the honest way of doing it. If they, hey, listen, I raised your taxes, I'm redistributing your wealth. It's a very bad thing to do, but at least it's honest. And they didn't borrow it they didn't even borrow it from the private sector. Say, okay, listen, I know you were going to put the money in the bank or spend it, maybe save it and increase productivity, but we're handing it to the government. We didn't even do that. We had $6 trillion printed by our central bank. Fake money, counterfeit money, if you forgive the term, but that's pretty much what it is. I mean, it wasn't derived from the savings and investment dynamic. It was just like, hey, we've got a problem here. Our asset bubbles are crashing. I want to just as a quick, parenthetically speaking, the Fed was already printing money before anybody heard of the word COVID-19. They were printing money in 2019 and reducing interest rates. So please don't be fooled to say, well, the government had to do this because we had a virus. Yes, we had a virus, a pandemic, and they did expedite the amount of money printed and interest rate reductions, but they were already in the process of going to zero anyway in 2019 when we had the repo market crash. So this is not a phenomenon that's unique to just the pandemic. So this is a situation we're in. It's completely unusual. It's not going to end well. And if you're not actively managing your money, and you're just saying, I'm going to buy this diversified portfolio of stocks and bonds, I'm going to keep it in because I keep it in, your favorite wirehouse firm, it's going to end very poorly for you because you have to be able to quickly navigate these cycles between deflation and inflation, or you're probably not going to have a very good retirement.
So right now, I think one of the big conversations or questions that I see is people saying, do I sell everything and I go into cash because everything's going to explode? A lot of smart people are saying deflation and the dollar is going to go up and then everything's going to go down. And then you see the 10-year rising and, this isn't a good situation. Whereas you have, another camp that thinks, maybe we have another deflationary cycle, but we're headed into inflation. The dollar will correct itself, that they'll either step in with yield control or we'll have the 10-year correct itself. Where do you fall in that camp as a wealth manager?
So going back to the last question you asked me, I don't think I wrapped up not your fault, my fault. I can wrap up my thought process. So you have $6 trillion that was printed and given out to people. It was handed out to state and local governments, businesses, corporations, and individuals. That's money just, diffused through the whole economy in the private sector. Creates this period of growth, but it's happening at the same time that the economy is opening up because of the vaccine. So my prediction is, and has been, and looks like it's panning out well, is we're going to have a very robust period of growth between now and say May, June timeframe. Unbelievable growth. GDP is going to just blow the doors off of anything you've seen in the past. Of course, the caveat, and I'm here every day monitoring it, I want to see how effective that vaccine continues to be. Do we continue to see in the United States declining infections, hospitalizations, and deaths? Most importantly, the latter two. So infections could go up a little bit, but what is the capacity of hospitalizations? And what is the rate of death? If that continues to drop, you're going to see the economy in the United States opening up, okay? Especially compared to, vis-a-vis other nations like Europe. Europe's having a horrible time. Brazil's having a horrible time with this vaccine distribution. So that puts more strength in the dollar. And it also tends to elevate our interest rates more because we are growing much faster than the rest of the world. But what happens in the second half of 2021? Well, Wall Street, I call the deep state of Wall Street, is saying, hey, we're gonna have a great year in 2021 and in 2022. I don't think so, Jake. And that's when, we talked about before, you're going to see a cycle that we have now, which is one of inflation and rapid growth. That's going to switch to one of disinflation, recession, and maybe even deflation in the second half of 2022, because you can't have another $6 trillion borrowed by our federal government and monetized by our central bank in 2021. It's just not going to happen. You're going to have 2 to maybe 2.5 trillion in 2021. And then in 2022, you're going to have that's the fiscal cliff. Then you're going to have a monetary cliff in 2022 because you're going to have an announcement, in my opinion, sometime around June or July. Think about, late spring, early summer, Jake, where the Federal Reserve is going to say, Jerome Powell will say, I am now going to announce that a year's time from now, we're going to start tapering our incredibly massive, humongous, gigantic $120 billion a month counterfeiting scheme. He won't say counterfeiting scheme, but he's going to have to taper it. So you're going to have a fiscal and monetary cliff. About the same time, you're going to start to see the maximum effectiveness of this vaccine kick in. So the maximum reopening of the economy will occur at that time. Fiscal cliff, monetary cliff, maximum reopening, and then the scars added to this, all the scars that are left over from this virus. And I'm not talking about physical scars, I'm talking about economic scars. 135% debt to GDP, $6.5 trillion of junk debt, CLO debt, leveraged loans, and BBB rated bonds that are set to implode once we hit that cliff. As we're recording this, and maybe even a few weeks back, you remember what happened with GameStop. I mean, GameStop, which was just a small company, a victim, if you want to call it a victim, of the Reddit crowd, Robinhood crowd, that stock blew some shorts, hedge fund shorts, out of the water, and these hedge funds collapsed. That caused a lot of turmoil. As a matter of fact, Thomas Petterfy, CEO of Interactive Brokers, says it almost broke down the entire financial institutions. The entire Wall Street almost collapsed because of GameStop, which was just a couple $100 billion company before it went from $4 a share to hundreds of dollars a share. And then today we're learning that this family office is almost destroyed the bank of Nomura Bank. That bank is down about 16% on Monday morning. Why? Because he made some bets on Chinese internet stocks that didn't work out so well. I mean, how could you're talking about, Jake, we are in the best of times. I just talked about how growth is going to be the highest growth rates we've ever seen in GDP right outside of World War II. And inflation is going to be well north of 2%, probably even 3%, because of the base effects of last year in May and June timeframe. Rapid inflation, soaring growth, reopening of the economy, checks going out to people. And this is when we see hedge funds collapsing and taking down major banks are in jeopardy, warning of significant losses coming. Jake, what's going to happen? What do you think is going to happen? Let's do a thought experiment. What do you think is going to happen when the federal government doesn't borrow $6 trillion, can't do it anymore because our bond market won't let them any longer? We don't have this, the solvency of our treasuries is in jeopardy. What happens when they can't print and borrow and hand checks out to people any longer with impunity? That fiscal monetary cliff is going to bring about a lot more GameStops and a lot more, I forgot the name of this particular hedge fund that blew up. I think it was Alagos or something like that. But you're going to see a lot more hedge funds blow up and take down a lot more banks when we hit this fiscal monetary cliff. And if you're going to sit there and tell me you're happy owning, your modern portfolio theory of 60-40 stocks and bonds, you're in trouble again.
So we primarily talk about, gold, silver, mining stocks, commodities, all type, broad range of commodities, uranium, all these types of things. And so if you are not, obviously you're a wealth manager, you work with, big successful people. What about your average person that's listening to this, that's invested into mining stocks or commodities right now, and they're looking at all this volatility and they're saying, like, am I in the right place? What do I do right now? Are you saying that you think, at least in this inflation phase that we're in right now, these things will fare well, even if there's a strong dollar or 10-year, or do you think commodities are not a place to be at all right now?
So I've been in this business for almost 31 years, a licensed professional. So I made a lot of mistakes. And one of the things that you have to ask yourself as a money manager is, do you want to try to make your clients money, or you just want to have a philosophical thought process and be right eventually? Now, I would rather, as someone who owns an SMA and an RIA, I want to be right for my clients. So if that's the goal, if you say to yourself, hey, listen, I want to make money in the precious metal sector most of the time. And by the way, that's not that hard to do. You have to know how to trade it. So what you have to understand is that precious metals, let's just say gold, silver, platinum, they don't like when real interest rates are rising. And just to make it very plain, very simple. So if nominal rates are rising, interest rates are rising, but inflation isn't rising faster than nominal rates, then real rates will be rising. I hope that is very clear.
Yeah.
And when do nominal rates rise faster than inflation? When growth and inflation are rising. So if you have inflation rising, at the same time that growth is rising, precisely artificial and temporary and ephemeral as it may be. I'm not saying we're having real growth. We're having horrific growth predicated on borrowing and printing, which is not going to last much longer, but it's here. So as a firm, I sold my miners in September, October of last year, late summer of last year. And I'm not talking about the gold that I own, physical gold. Everybody should have about 5% of their net worth in physical gold, always. That's just as a placeholder of your wealth. But I'm talking about the percent of gold that I toggle between 0 and 20% in the portfolio. That went down to 0 physical gold and no miners. Because I predicted, because of the model that I have, that we were going to have a period of rising real interest rates. And people say, well, Michael, what are you talking about? What? I'm an idiot, right? I'm an idiot. You just said the Federal Reserve is printing all this money and inflation is rising and the government is destabilized. Why would you not own precious metals? It's about getting things right because you understand the actual dynamics behind what's happening and how the algorithms on Wall Street are programmed. So if you're an active trader, then you listen to me. If not, you can go out and just, dollar cost average into gold. Look, listen, the gold market has destroyed the S&P 500 since 2000. Okay, so buying and holding gold has worked. However, buying gold mining shares in 2012, because Ben Bernanke said we're having QE, 85 billion a month without end, infinity. QE infinity was 2012. It was a horrible decision. You lost 85% of your money in gold mining shares from 2012 to 2016, 2015, 2016. But you don't have to do that. And you shouldn't want to do that. You should want to be better. So that's what I want me and my clients. I want to get better. So having said that, well, when would you get back into the miners? When you get back into gold, you ask. Well, in the latter half of 2021, it's coming. I think it's coming very soon, in just a matter of a few months. Once you reach the maximum reopening of the economy, and once you start hitting fiscal and monetary cliffs, you'll see nominal rates drop much faster than you will inflation. And that'll bring real rates lower. And that's a wonderful opportunity. Imagine buying gold and gold miners as when on the announcement that the Fed is going to taper in a year. That's how you make money on Wall Street. So it's a little bit counterintuitive, but it's a good if you back test what to do, that's the correct path to take.
So when you're discussing these rising yields and the effect that they have on gold and silver, right? And we're obviously seeing that play itself out right now. Does these rising rates in your models have an effect on other commodities, whether it be oil, whether it be uranium, whether it be copper?
Of course. You'll see the base metals collapse. Oil and all base metals will collapse in the second half of 2021, in my opinion. That's my opinion now. I mean, I reserve the right to change my mind, but as of right now, it looks like that's exactly going to happen. Because you're going to have a rapid deceleration of growth in the second half of 2021 and into 2022. Why in the world would I want to buy copper or uranium or agricultural commodities or energy? No, you wouldn't want to do that. You wouldn't want to do that at all. And we just talked about, Jake, I'm trying to impress upon people how fragile the whole economic system is. You think about 2008, total market cap to GDP in 2008 was about 100%. You had a bubble in housing back then. You didn't have a bubble in the bond market at all in 2008. Fed funds rate was 5.25%. We're now in 2021, we're 195% total market cap of equities to GDP. So it's just the value of stocks compared to the economy. Makes common sense. It's never been twice the economy, nearly twice the economy. Well, here we are, almost twice the economy. In fact, in the year 2000, it was only 140% of GDP. So we're at record high valuations in stocks, and we also have another housing bubble to deal with. If you look at home price to income ratios, they're back to where they were at the apex in 2005. And of course, we have never had a bond bubble anywhere near. I mean, this is incredible. Incredible. You have $15 trillion worth of negative yielding debt in the world. Imagine that. When you get paid to borrow money, you get punished as a saver. That has never happened before. So these three bubbles, triumvirate of bubbles, bonds, equities, and real estate, will pop. It's going to pop again. I can virtually guarantee you that. And on the other side of that, you don't want to be anywhere near stocks or commodities. No.
Right now, or once we head into that deflationary swing that you're saying you think comes around at the latter half of the year?
Right now, I'm still, I have, my exposure is stocks that benefit when the yield curve rises, expands. So you think about banks, long industrial metals. I'm short the long end of the yield curve. So it's not time yet. This is what I'm here every day saying. Is it time yet? What are the credit markets doing? You'll see high yield spreads. High yield spread. I hope I'm not getting too arcane. You just say, Michael, what are you talking about? And I'll try to get.
I'm with you.
Okay. So if you get junk bond yields start to rise way faster than the yields on treasuries do. In fact, treasury yields start to fall as people pile into treasuries for safety and they sell their junk bonds. Those yields rise, right? That's going to happen, and it's going to take down that $6.5 trillion that I mentioned of junk bonds, the triple B and CLOs that are out there. That's going to bring down a lot of hedge funds. Somebody owns all this paper. But those are the kinds of things I look at to tell me when the cycle changes. Break-even spreads, LIBOR spreads, junk bond spreads. I have 20 components to the model. So right now it's saying, green lights are fine. Green lights. It's just, we're inflating and we're growing. But when does the epiphany come from Wall Street that we're heading in the other direction? I'm still hearing on CNBC all the time. Hey, listen, 2021 is going to be a great year, and 2022 is going to be a great year because the pandemic is going to be behind us, and we're going to have a normal economy. It should. Here's the problem, Jake. It's almost impossible. Think about it from 2003 to 2004, interest rates were taken to 1%. which engendered the housing crisis. Then we raised interest rates, we blew up the housing market. So as I said, I think I mentioned this before, 8 out of the last, 10 out of the last 12 years, we've been below 1% on the Fed funds rate. You just can't extricate yourself out of that artificial dynamic innocuously. It's impossible. It's never happened before, and it's not going to happen again, because you can't artificially manipulate markets for that duration and that extent and get out of it without destroying the asset bubbles that you help perpetuate by that very process. So unfortunately, and look, I didn't make the rules. It wasn't my decision to take interest rates to 0% and leave them for 7 years and go to 1% and then to 2.5%. Remember, we went to 2.5% on the Fed funds rate in 2019, and then to the summer of 2019, and then the money markets completely froze over, and the Fed had to go back into QE and dramatically start to lower interest rates. They did it 3 times before January, so we had a big problem in this country. You just cannot ever go back to normal unless you agree that as we normalize interest rates, we are going to have a humongous problem in all markets. And who's going to, I mean, what president, what central bank head is going to come out and tell you, hey, we're going to have a depression for a couple of years and there'll be people starving to death, but that's the only way out of this. Well, here's a little factoid. I'll give you a little bit of fact. So we have a Janet Yellen, who used to be our, Federal Reserve chairperson. Now she's the head of the Treasury. So much for the Chinese wall that should exist. Can you say Chinese wall? I don't know if you can. There's a wall. There is a wall in China, by the way. So there's really a wall between Treasury and the Fed, right? Well, we have the same person who's now saying, Janet Yellen is saying, hey, we could continue to borrow money with no problem right now because our debt service payments are quiescent. Well, why are debt service payments quiescent, Jake? Because the Fed took interest rates from where they should be. The normal interest rate we pay on our debt is about 6.5%. It's now 2% because they printed all this money. If they stop printing all this money and we do normalize interest rates, our deficits would go from incredibly large 16.5% of GDP to 35% of GDP, our annual deficit, if we had a normal interest rate regime. This is why you can't, I hope I just proved the point here, you can't ever normalize interest rates. You can't, because you'll destroy the solvency of our own government. So that's why you're going to have a lot of chaos no matter what happens. And you better be quick and nimble and be able to adapt to it.
So some people that I've had on the show, they've talked about essentially a massive inflation, modeling a Venezuela type of situation where, maybe they bring rates negative and then they go crazy on the money printing, but maybe, the economy still stalls up, but the asset bubbles and everything, whether it's stocks, housing, everything just keeps going up. Can you explain to me why you disagree with that?
I disagree with it, not in its eventuality, but in the fact that it's not going to happen now. The next cycle we're going to have, in my opinion, and I will, live up to this opinion. You can have me back on and see if I'm correct. The next cycle is going to be disinflation and recessionary. And people say, there's the gravitational forces of deflation are absolutely enormous. And what does that mean? What is a gravitational force of deflation? Is that when you have a tremendous amount of debt overhang out there, and we're close to 4 total debt. So if you look at state, local government, federal government, corporate debt, household debt, we're almost 400% of GDP. It's never been higher than where it is today, Jake. And when you have to service that debt, it just means that you can't grow the economy and you can't borrow money as freely as you would if you had debt to GDP at like 50% where it used to be. And you can say, hey, listen, interest rates are stable and normal, and I have a lot of liquidity here, and I want to borrow money, and I want to get the monetary velocity up. I can borrow and spend, and then you can get the growth of money supply booming. But I don't think that's going to happen in a linear fashion. That's all I'm saying. I'm saying it's going to happen, but the trajectory, the vector, will not be linear. It'll have lots of these things in it, because you're going to have, in order to get never-ending, exponential growth in inflation, which is, linear and then exponential, like a parabola. You're going to need, for me to agree with that, to assent to that, you would have to have me hear that Biden and Yellen agree on a universal basic income of thousands of dollars for every man, woman, and child in the United States who makes under whatever they call rich, 200,000, whatever. And all of that will be permanently monetized by Jerome Powell. Then they would be correct. But that's not happening. We're not there yet. It takes these deflationary, recessionary, or depressionary crises to get them there. Now, I think they will one day get there. Maybe it will be after the next crisis. I don't know. But I don't have to make these stupid predictions like 2023, the GDP will be here. That's just, you don't know. You don't know. I don't know. You don't know. Nobody knows. But what you do know is what's happening. The fiscal and monetary regime of the G3 nation blocks, so United States, Europe, and China. If you know their monetary and fiscal policies, you can predict where we are in the credit cycle and invest appropriately. But after that, you don't go out. You can't go out 5 years, 10 years, or even 3 years. Go out a year or two. That's all you could do.
Okay, so a lot of times when people hear I guess when the veil is lifted on the financial system, it can be very, it's kind of intimidating, right? And some people will say it's just negative and you need to be more positive and whatever. But one of my favorite parts of the show, and really why I started this show, is really to essentially, for myself, first of all, and secondly, for as many people as possible, help people prepare as much as they can. Of course, financially with investments, but then also philosophies, mindsets. What do you think are some of the most important things that are places for us to begin? And that's a broad question, right? Because there's financial components, there's probably some philosophical and mindset components. But what do you think that people need to know or are missing most?
Are you talking about economically or philosophically?
Yeah, we'll start there and then we'll move in.
Religiously, or what?
Why don't we start financially and then we'll move across the spectrum into how people are.
Well, I don't think they're missing. I don't think they're. I mean, right now they're just enamored with bread and circuses. I mean, we had an election in Georgia, which was like the election in Georgia for the Senate runoff was, hey, do you want $1,400 in your pocket or not? Well, I mean, so that's a binary decision. Well, I believe in freedom. I believe in capitalism. And, but I really only need that $1,400. So, I mean, so right now, I mean, but people, listen, Jake, look at you. Look how popular you have become. Obviously, you're very handsome and very intelligent. But why are you so popular? Because people viscerally understand there's a problem here. They're not going to get it on putting on CNBS or most of the mainstream financial media. They're just not going to hear what they're hearing on your program. They understand that this is not reality. They understand that interest rates should be higher than zero, that savers should be compensated for deferring their consumption and putting it in the bank should get something other than zero. They understand why home prices shouldn't be going up 30% a year in some parts of the country. Again, they understand that GameStop shouldn't be going from $4 to $140 in a matter of a day or so. So they say it. If they don't cognitively understand it, they at least viscerally get it that something is wrong, and they want reality. They understand they want reality, so they're coming to places like this. And if you want reality, you understand that you just can't have markets being artificially manipulated by people, and I mean a small group of plutocrats, take over and usurp markets forever. Very dangerous. They understand that.
If you were teaching a short class to 150 people off the sidewalk, right? And 150 people off the sidewalk, if we kind of take our, if we kind of take our average statistics that we know, at least before the lockdown started, at 75% or so of people living paycheck to paycheck, the average person can't come up with $500. But let's say they visually get it, but they just aren't, they aren't a multimillionaire in a comfortable place, but they realize they need more money to get more freedom because people are losing their freedoms. But then there's all these cyclical volatility in the markets that have negative consequences. And they're saying, Michael, like, what do I do? How do I get ahead? If you were to distill that into a couple key points, where do you think one begins to start to break out of the system or the matrix, so to speak?
Well, I mean, I don't know, Jake, do they really want that? Or would they, it's very hard to tell people that they're going to have to suffer for a little while, cut back on their savings, cut up their credit cards, work really hard. And I'm sure they are, by the way, I'm sure they were already working very hard, but it's very hard to get ahead when we call it the matrix, but the economic paradigm is such that it so heavily favors the rich. Mm-hmm. So do they vote correctly? They gotta start politically and vote correctly and vote for candidates that aren't going to tell them everything is fine if we just keep handing you money. This is prescription for a disaster. When I was a kid, I remember my grandfather told me, who came from Italy, he said, listen, there's two things I don't want you to do. You never take a dime from the government, ever. And he said, if you can't afford your house in cash, you can't afford your house. Now, those are two very extreme positions, but I think we need a little more of that in multiple societies, not just American societies, across this world, of reality. We need to save money. The savings investment dynamic is broken, but to the extent that we can fix it, we should.
Where did your grandfather get that idea from to not take any money from the government? Rarely do you hear someone say that that's what their grandpa told them, right?
Maybe that was the philosophy from, I think there was a lot of patriotism too back then. I mean, my mother used to make me stand for the national anthem when I was a kid. The Italians, when they came here, I'm not just talking about Italians, I'm sure it's multiple immigrants came here and they wanted to be Americans, and they wanted to work hard to improve and add to the country rather than take from the nation. They were like, John Kennedy said, what can you do for your nation? Ask not what you can do, what your country can do for you, but what you can do for your country. It was kind of what the philosophy was back then. I think we need a lot more of that. Not what I, and I don't blame people. Listen, I get it. The bread and circuses mentality is very alluring. Listen, I'm working very hard. I'm falling further and further behind. So the government needs to help me. So I mean, I don't have all the answers, but I think we need to start with the epiphany that government cannot solve all of our problems. People solve the problems, not government. Government serves to, and I'm not getting too political here, but government, as Ronald Reagan says, is a cancer for freedom and for the long-term viability of a nation. So less government, cut spending, lower taxes, a bona fide strong safety net is absolutely something I espouse. But freedom in markets. Let's start here, Jake. Let's start with the determination that the cost of money should be a function of savings and investment. So if you save a lot of money, put a lot of money into the banking system, interest rates fall. You don't save a lot of money, interest rates rise. And it depends on the demand too, but that's the basic dynamic. And a group of 12 or 15 people that sit on the Federal Open Market Committee they don't have the intellectual power. No individual has the power to dictate what borrowing costs should ever be. And we've had a group of small, like I said, plutocrats decide that money should be virtually free for 10 out of the last 12 years. And that is extremely dangerous.
Well said. I think it's a powerful spot to kind of wrap up at. When I hear like that, what it does to me is it makes me realize that I'm the only one that can actually save myself, and having that personal responsibility, has been an important component to me, getting ahead and getting to where, I've been able to get to. And I think one of the hopes with this channel is that we start to breed that. We create more and more people that kind of have that community or that motivation to build that resolve. And as you said, that discipline, and begin to, obviously we can't invite everyone on the journey, but as best as we can prepare ourselves for what's coming. So let's wrap up with where can we find you? I mean, obviously we know you got your Pento portfolio company, which we'll link right there down below. And we know you got your books out there. Anywhere else we can find you?
Well, I just want to say, just to wrap up what you just said before, faith, strong families, and hard work, confidence are all very, very, very strong pillars of a successful country. Strong middle class too. And that's exactly what that does. It supports a strong middle class. If you want to come to the website, it's pentoport.com. I have a 5-week free trial for my podcast called the Midweek Reality Check, which I give you like a 36,000 foot overview of what's going on. If you have around $100,000 to invest, you can become a client of Pento Portfolio Strategies. The number here is 732-772-9500. You can email me at mpento@pentoport.com.
Midweek reality check. I like that one. So for everyone listening, give us a comment down below. Let us know if we missed any important questions or things that you'd like to see discussed. If you'd like to see Michael back on, make sure you hit the like button over on this side or that side, wherever it is. Send this video out to more people. This channel is all about really just trying to help as many of us wake up to what's happening, prepare ourselves as best as possible. So if you think this video does a good job of doing that, be sure to not only hit the like button, but consider sharing this out on social media. And thank you, Michael, for joining.